Capital confidence, institutional investment in digital assets. Now, can I please invite our moderator and our speakers? Moderating this is Syed Mushir Ahmed, founder of FinStep Asia, and our speakers are John Cahill, COO Asia of Galaxy, Chris Yu, CEO of Signal Plus, and Hans Kung, CIO of Pulsar. Gentlemen, over to you.
Thank you, Joey, and thank you to Terminal 3, Web3 Harbour, and the supporting organizations for having us today. I'm not going to take too much time talking about myself. Brief background: was a prop trader for one of the world's largest futures trading firms for the first decade of my career. Last 10 years have been in fintech and digital assets. Recently was a regulator with Virtual Assets Regulatory Authority of Dubai as part of the founding team, but now back in Hong Kong. Before our panelists mention and talk a little bit about themselves and the topic at hand, please note none of what is going to be said on this panel is investment advice. Please do your own research and ensure that you're complying with the regulations so that we don't have any challenges with speaking to SFC afterwards. I'm going to ask our speakers to introduce themselves and their firms, and then we'll kick into the conversations very quickly. John, let's start with you.
Hey everybody, thanks for spending your afternoon with us. I'm John Cahill, I work for Galaxy, run Asia, here based in Hong Kong. We do kind of soup to nuts, just about everything you could think of under the sun in crypto, from investment banking, markets, both on the buy and sell side. We have an asset management business with $9 billion of AUM under a whole bunch of different products, everything from venture to ETFs. We have an infrastructure business that does staking and infrastructure. We have a custody technology that we sell to third parties who then stand up their own custodian. And we have a big data center out in West Texas that came from our original investment in a Bitcoin mining facility, which we pivoted about a year ago, and will eventually, once we get our build done, will be one of the biggest data centers on the planet.
Thank you. Chris?
Yeah. Good afternoon, everyone. My name is Chris Yu. I run this company called Signal Plus. Signal Plus is a company that builds derivative trading infrastructures. We build multiple products, but products mainly serve professional traders, big trading firms, market makers, and also infrastructure for exchanges. Our infrastructure covers most of the trading firms and exchange right now. Both Galaxy and Pulsar are already our clients. We think blockchain is a good technology for clearing and settlement. We build a derivative infrastructure on top of a blockchain technology so that one day when all the assets will be trading in token, the technology that we build can be leveraged to reform the whole financial industry. Thank you.
Thank you. And Hans?
Hi, everyone. My name is Hans Kung from Pulsar. We are a high-frequency trading firm focusing in the digital asset space, providing liquidity to the market. Been around the space for more than 10 years, and we trade on a very wide range of crypto exchanges that you can name off, from the household name, be it Binance, Coinbase, et cetera, to also the lesser known names. And we work with the two gentlemen here very closely, so happy to be here.
Thank you all. Look, when we look at institutions, one of the first things is to kind of define that, as John and we were discussing beforehand. While we go into the first question, it would also be good to hear what your definition of institutional investors or understanding is, right? Because this is a broad definition. Different people look at it slightly differently. Let's forget the regulatory conversation, but as a business, what do you think about it? And as you define that, we've seen significant interest from institutional investors of various kinds in digital assets over the last couple of years, right? There have been certain instances that have triggered that, and for any market and an asset class to mature, it's quite important that you have good institutional interest, because that helps with scale and growth on a longer term and more elements and optionalities that kick in for trading. So John, what would you, we'll come to Chris and Hans as well, what are your thoughts on how are you defining institutional investors, but what has been the changes that has triggered this increased interest in institutional interest in digital assets?
Sure. So we are focused on the institutional investor in crypto. That was kind of the genesis of the company back in 2017, 18. I think for what defines an institutional investor, it's really the size of investable funds.
Sure.
And that's individuals, it's founders of crypto companies, it's crypto-specific asset management businesses, one of which we're one of those ourselves. And then broadening that out to not just the crypto natives, but it's pension funds and endowments and sovereign wealth funds. And so those constituents all need different things and have different thresholds for accessing a market, accessing counterparty risk, getting comfort with the mechanics of the market and the specific challenges of dealing in crypto are really far off still for some, and are challenges that have been accepted and I would say industrialized in some of the institutions. Part of our job is to educate. But I think in terms of shift that we've seen is that there are really no access point issues anymore. 3-4 years ago, before ETFs, before DATs, you had to do something extra to access crypto markets. You have to manage keys. You have to manage the risk of dealing in bearer assets. You have to be concerned about hitting the wrong button. Is an irreversible transaction, and that has existential risk for a company, let alone just the headline risk. And so a lot of those friction points have been dealt with, but we're not seeing some of the more permanent capital in the space directly investing in crypto. They're using ETF products, and I think now more people will look at DATs as well.
Thanks. Chris, your views on what? Go on.
Sure. So from my perspective, the definition of an institutional investor is a very general concept, but we just have a different group of institutional investors that has different risk appetite. So I will actually look at this in different risk appetite. The institutional players who has the biggest risk appetite, who participate in the market early enough and build up the liquidity, which become an essential condition for other institutional players to come in who has less risk appetite. So I think in crypto, we already come through the stage where we build enough market depth, we build enough liquidity, we build enough trading participants coming into the market, and now we are waiting for the institutions who has probably bigger balance sheet, less risk appetite, doing allocation, doing yield enhancement, or we would define those institutional users as the real money players. When this group of institutional players come into the market, it will be a big impact to the market. It will also bring in more depth to the market, more liquidity. It become a positive feedback. But I think for institutional player, it's actually across all different appetite from day one of this asset class.
Thanks, Hans.
Yeah, I think over time, right, not only the type of money that have interest in the space has changed, but also the perception of the asset class has also really changed. Like a few years back, I think when more traditional money think about crypto, they probably relate it to exponential crazy upside, right? If it's not 100x, 1000x, they wouldn't even want to chat about it. So I think a few years back, a lot of the interest from the traditional side were also in the venture side of things, because obviously there were a lot of success stories, in the sort of pre-2020 vintage. But I think, after 21, most of the vintages after that had, significantly deteriorated return, partially because, there's a lot more capital coming into that venture space, and premium got bid up, right? Valuation got a lot higher, yada yada, and so fast forward, I think even if you're talking to the same set of investors, I think their appetite had also become a lot more mature, whereby, like Chris said, they start thinking about yield enhancement, they start thinking about allocating into hedge funds, systematic strategies, for more in-line return with traditional market, if you will. So yeah, I think that evolution have been interesting to see.
Yeah, I mean that's sort of, I think, a really good point to make is institutionalization of the asset class leads to lower returns, right? It's price discovery becomes less edge. And so as more capital comes, the volatility is continuing to come down on the majors. You know, the very, very long tail of alts still have a lot more volatility, but you know, what drives that pricing is not institutional money, it's you know, small speculation.
Yeah, I mean, and also on price discovery, you know, obviously, you know, people talk about, you know, institutionalization of the asset class, you know, when institutional money are coming in. But I think the fact is, I think, you know, on the, you know, on the very deep level, on the order book level, liquidity layer level, you know, actually a lot of the household names you hear in the traditional space are actually already in, you know, especially in market making, right? So yeah, I mean, a lot of things have actually changed, you know, behind the scene over the past few years. Yeah.
And I mean, you can add to that fact that with BlackRock saying they're going to tokenize everything and having their own ETF and various products, that whole shift of the world's largest asset manager with AUM close to the world's second largest economy's GDP has that big influence on other institutions, more traditional finance institutions also getting in beyond your buy side, as it were. And building on that conversation, Hans, with regards to capital allocation, what do you see in institutions having an interest in, institutional investors, generally speaking? Is it more looking at derivatives, spot, or, you know, we had a whole phase where venture exposure was a major conversation. Any thoughts on that?
I think John and Chris would be a better person to answer this question. But in short, like I said, right, in a few years back, I think anecdotally, there's definitely a lot more interest in ventures when it comes to allocation. But fast forward, I think these days, people probably like to think about, you know, structured products in a systematic trading a lot more, because you know, as the asset class matures, right, you know, your return also normalizes. But it doesn't mean it's worse risk reward. You know, it's just less volatile.
Fair, yeah. It's still an alternative asset class. Right? John, your thoughts on that?
Yeah, look, I think there's some realization, and I think it's been really hard to raise money for venture. You know, we closed our first venture fund with external capital in June with 175 million, but it took solidly 2 years to find that money. We've been investing on the venture side, you know, for the better part of 10 years as a company, so it's very hard to raise money on the venture side because of the liquidity lockup. And people just don't want to have capital, you know, deployed for seven-year returns, particularly because the opportunity set has been challenged. And you have huge money that was raised in 21, kind of 22 before things started to go sideways and before FTX blew up. And the returns haven't been remarkable. And you know, if you're giving away liquidity for a long time horizon, the returns need to justify parting ways with your money, and so that hasn't really been there. So liquid strategies definitely have been way more popular. You know, I would say it's also been tough on the return front, especially where we've been through now the better part of a full crypto cycle without a real alts run, where it's really the majors, and you'd be better off just owning Bitcoin outright instead of having a diversified portfolio across the alts. So we definitely see institutional money more going to there. And you know, you can still capture pretty significant outperformance trading around in Bitcoin, because despite the volatility coming in a lot compared to history, it's still a much more interesting asset than others.
Chris, your views?
Yeah. So from my perspective, I actually look at this in different group as well. So one is professional traders, just as John said. So the first stage actually is you get access, you start to own some Bitcoins, and right now, after BTC grow as like trading asset class, more and more institutional players just own Bitcoin as allocation. But at the same time, we were actually discussing about the competition and the high frequency trading. The fact that the market become high competitive, it's actually because more professional players coming in. Once you hold the asset, you will want the yield on top of that. But then on the other hand, there are also investors who are generally slower. They are basically not, I would say, not tri-fi way of institutional players. They only start to allocate now. But the good thing is, it's not too late, because their amount of money, like even 1 to 2% of a passive holding, it will be big flow into the market, which will actually attract more institutional players to come to the market. So this ecosystem become more healthy. You have some first movers that are already trying to compete in high frequency trading to generate better alpha. But then you also have the follow investors who are still at the stage of I'm going to do the allocation, and then next big wave, also Hans as I mentioned, it will be structured products, because all these passive holders, when they come in, they are not going to compete alpha themselves. They are going to construct their yield profile using structured products, all this kind of thing.
I'm also going to take this conversation forward, digressing a little bit from our original question list, but I think the conversation on alts and the move into alts, right? Previous cycles from a Bitcoin or crypto cycles, you'd often see when Bitcoin was nearing a peak or near a new high, then the Bitcoin whales were the ones who were taking a bit of the profit going into alts, right? And then the alts saw the run. But in this cycle in particular, there have been multiple instances where people are like, oh, now we're going to go into it. My intuition on that is because for large institutions, especially non-crypto institutions, digital assets themselves are an alternative asset, a higher risk asset. So even if they're going to book profit, they're not going to run into alts. They're going to probably just reallocate or put it on the sidelines in cash or treasuries if it were. Thoughts on that for you, gentlemen? Yeah, sure.
I actually think, I mean, just now you mentioned about the demand side of things, right? But I think it's also a supply kind of, I think the supply side is even more important, because a few years back, well, 21, 22, a lot of the venture funds, basically got, it was a record year for them, if you were to fundraise. And a lot of those money obviously went into primary market, the pre-launch products, essentially. Fast forward years later, that would basically convert into new token listing in the market, right? And that has still been ongoing. So I don't have the exact numbers with me, but if you were to compare the numbers of VC-backed tokens in the market now compared to, it's quite like 4 or 5 years back, it's like magnitude higher. So not only the demand side is not catching up fast enough, but the dilution is real. So I think that also sort of explains why there's an underperformance in our side. Now, obviously, there are exceptions, right? Fundamental does matter a lot more now. Certain protocols are also generating revenue or whatnot. But I think market had also become a lot more selective in what tickers to buy, if you will.
I agree with that. I think there's more now a usefulness test than there ever has been. There's an awful lot of money being raised by an awful lot of projects that haven't delivered anything useful or value to the market. I think the raising money in and of itself was the goal, and they were very, very successful at that. But there was no kind of follow through or delivery on delivering something that people cared about, that people want to use, that creates something beyond a narrative. And so I think now the test for allocating, apart from like the dark corners of Twitter, is a lot higher.
I think it's a natural progress of risk return or risk reward. The risk reward was extremely good like a couple years ago. If you invest $1 and the multiple is 50 to 100 easily, and it become a little bit binary option, and therefore the money will come in because you are able to make like 50, 100 times using small check. But then now, because the market are become more like conservative, actually because the multiple has dropped. If you are only making 2, 3 times, you are a good project. But again, I need to evaluate your good project first. But before that, if the multiple is big enough, I can be a little bit like careless. I can be like a little bit selective to invest 10 projects as long as one of them made it. Then I made 100 times, that covers everything. So the multiple itself reflects the risk reward reflects the multiple and reflects the nature of where we are now.
I think the 2018, 2019 ICO boom was spray in, not just spray, but celebrate, right? You put in, even if the projects were failing afterwards, the token prices were rising significantly and people were exiting and making that money, but now you don't necessarily see that. Plus also the fact that ICOs in itself have become more restrictive in terms of how we can go out and raise funds. So capital flowing there. I'm going to build on your previous point, Chris, with just taking you back with regards to structured products, right? What are you seeing institutions looking for? Are they looking at yield? Are they looking at hedging? Or are they just going to want to play the optionality and make money out there like Jane Street did and does often? Yeah. Chris, start with you.
Sure.
Yeah.
I think today when we speak of structured product, it's definitely probably the best timing because the structured product is basically a basket of derivatives on top of the underlying asset. And to have a proper, healthy structured product market, you will need the underlying asset to be liquid enough, good depth. And now we have the majors are in, I would say, significantly good liquidity, even sometimes better than some EM currencies. So now it's a good overall environment. And then you have to have the buyers of the structured product, which is also here, the follow investors who has allocated their capital, even 1% to 2%, the real money investors, they will need to generate yield on top of their BTC holding. So that's all natural demand of structured product. And then to make the trade happen, you will need the infrastructure that supports how we can get the trades done. You will need the participants, strong market makers who can make a good price on top of that. But then for the infrastructure that we are dealing with is slightly different from what we deal with in the bank world. In the bank, the market, let's say equity market, open 5 to 8 hours per day, and traders can sit on the desk and make the price for that 5-8 hours. Afterwards, go out for happy hours. But for crypto, it's a 7/24. You would no longer be able to go out for happy hours, or you probably will make some lousy price and then tell the client, I'm going to make you the price next day, which doesn't work because crypto works 7/24. So you would need more automation. You would need stronger infrastructures on risk management as well. And also, you would need actually more quantitative traders who are able to structure the risk management in a fully automatic way to manage this. But I think today we are at the right direction. We are almost ready. We probably need to sort out a lot of collaboration together with regulatory framework to make this happen. But then I think structured product might be the area I think has the biggest explosive growth in the next couple of years.
John?
Yeah, look, I think the fundamental building blocks are there to have a robust market. I think counterparty risk is certainly part of the story that hasn't been completely, written. I also think it's a great use case for DeFi because it's really just composed trading using publicly available information. And I do think, that would be a great first DeFi project for some government to get behind. Probably one I'm going to talk to the local government here in Hong Kong about it sooner than later because I do think of all the different things you can do in, with composable money. I think structured products is a great one. We see the demand. We see the demand from family offices. We see the demand from individuals. Some mirror what they do in the existing world in equities and in currencies. And so with a high vol, relatively high vol for Bitcoin, Ethereum, that enables very high yield on the back of structured products, and that's where the attraction comes.
You had something to add? Go on.
Yeah, just some point to add on. So using blockchain technology to solve the counterparty risk would be ideal. We actually have been together communicating actively with government as well, because at the end of the day, if government support a standard derivative clearing protocol that is on chain, then that will be perfect use case of reducing all the counterparty risk, not only for structured product, but then the first good scenario will be structured product because the payout is clear.
And you can, with the blockchain settlement, the intermediary is not needed in clearing and a lot of that. I'm going to build on for both of you, and Hans, feel free to pitch in, is with digital assets, one of the key differences to your traditional financial assets globally over time, except for maybe FX, is you're typically trading on 1 or 2 venues, right? Maybe 3 or 4 in the more emerging markets for commodities. But broadly, it's more challenging for you to do it in multi-countries and multiple venues. Whereas with crypto, you can do that not just in the same country or jurisdiction, but in multiple jurisdictions, right? And that provides a lot of hedging options, etc. But are you seeing institutions or general interest more being, let's keep this local, or are you seeing the whole global conversation? It's also timely given what we saw with CFTC opening up global liquidity to the US, and now SFC talking about the same in Hong Kong. So the regulatory framework seems to be moving that way, but irrespective of that, what are you seeing the institutional interest for more cross-border, multi-venue hedging trading versus local jurisdictional based?
I think from the institutional side, I think that border definitely matters a lot less, right? Because by definition, if you're a Cayman entity, then you can be onboarded into multiple jurisdictions anyways, and that is also why quantitative trading or market making is interesting in the digital asset space, because, like you said, right, there are multiple venues. The liquidity in the digital asset space is a lot more fragmented compared to any other traditional assets, right? And that sort of creates, quite a lot of arbitrage opportunities and other things for trading firms like us. So, obviously for us, we are more indifferent. As we trade, we also provide liquidity to the market, right? But it does attract a lot of traders into this space because of it.
Crypto is borderless. Right? Crypto is borderless. Regulations are local. And so, I think, and it's somewhat artificial when it's applied to crypto, and I think the impetus of every jurisdiction is to put tight controls on people in their jurisdiction interacting with global exchanges potentially, or not participating fully in the global nature of what crypto is. Over time, and look, the entire world is moving in a more regulated direction. We're certainly in favor of that. Safety increases liquidity, increases participation. That's net directionally where things must go. But you also need some harmonization of rules, because if you're creating arbitrage opportunities just through regulation, it actually undoes a lot of the good intentions of the market. And so it creates lots of opportunity for traders, but it doesn't really, I would say, create the right environment to have a borderless type of currency or market, which crypto certainly is.
But I think we probably can see the scenario of a trader are able to trade across asset together with a crypto very soon, maybe next year, after tokenized equity. So the tokenized thing will basically get better access to most of the investors. From a pure trader perspective, I would really want to be able to trade, let's say, BTC vol against some equity vols together. There is actually good opportunities, but then because of the barrier of a cross asset at the moment, you are not easily able to do that. Either you sacrifice the capital efficiency on your balance sheet to cross a traditional finance venue versus a crypto venue, or you just don't do it. Otherwise, it's a waste of your balance sheet. But I do see that's happening, and actually all of us are building infrastructures to support that.
I'm just going to add, you make a very good point that not many people talk about is when you're looking at multi-venue, multi-jurisdiction, capital locks come in, right? The more venues you have, the more capital is going to get locked, your margin requirements, et cetera, which then isn't just sort of, we can trade everywhere, but then you're going to keep locking in part of your funds into it, and which becomes a question then of whether you do want to do that versus maybe getting yield. But maybe there'll be a good, interesting yield product that comes out of locked-in funds for collateral or otherwise. Hans, you had something to add? So I'm going to come to you on something which we were briefly discussing, but look, I was a trader on CME trading rate futures in 2005 when Hurricane Katrina came in, but I was a point-and-click trader managing to trade from the other side of the world. I was trading from India and into the US markets at 300 milliseconds, thereabouts for a round trip of a trade, right? But that was because there was a transition from pit trading to digital trading. And so it was the same product, but now fully digital. However, when you think of crypto, right, it is a natively digital product, right, which then enhances the ability for algos, quants, and now with AI's maturity for AI agents and others to be able to execute. So your thoughts on what's the growth you're seeing on specifically AI-driven traders and trading strategies versus more quant and smart algos? I'm making that distinction where the code is built in quant by a human versus the AI trading which is driven by whatever AI models you're using. But would love your thoughts.
I think, well, first of all, well, like we discussed, right? I don't think it's really a crypto-specific sort of like phenomenon. I think AI has already have an impact on pretty much any industry, right? In terms of our daily workflows or whatnot. But in terms of like, do we see a trend of more machine learning, deep learning type of technique being used in our models? For sure. I think specifically for crypto, the reason why it has attracted a lot of quant traders is because if you look at crypto market as a whole, right? Comparing its liquidity, market cap to equity, it's actually still a small market, but yet it has attracted a lot of quantitative traders because it's a 24/7 market. So there's abundance of data, for traders to look at. So naturally, because of the availability of data, people are also able to, sort of like leverage on them to train their model and all that. So we definitely see trends there. But I wouldn't really exactly sort of like separate that from smart trading because at the end of the day, right? I think. Obviously, traders also wouldn't tell you what exactly, what are the exact signals they look at. I believe, it's kind of mixed these days. A lot of traders I know, or even internally, they also, sort of like, leverage on machine learning to generate some of the alpha. So it's becoming harder and harder to differentiate. But at the end of the day, I think that human involvement is still very important because when it comes to a portfolio construction level, you still need to have your own judgment, right? So I don't think it's easy to segregate them per se. Yeah.
And especially for options trading, right? A lot of times the decay, etc., is more challenging for the human to keep up to date. And my founder used to say, only futures, no one's touching options, and he had done 30 years trading as a lifetime, honorary in CME and on their board, but he was very much like no options because he felt it was too risky, even though we had a very large risk team. So,
what you have described is a very good example of a use case of the large language model, which is also the agent. They're like from concept perspective, what Hans said, all the quant trading are using machine learning. It's different from the large language model. It's also AI, but then this is a generating alpha. The large language model is more good at reasoning. So if we are using like ChatGPT, DeepSeek, or this model to do trading, actually it's not there yet. It's good at reasoning, but it's not good at calculation. You are not able to even rely on AI, a large language model, to give you an accurate Black-Scholes model yet. But then it can do a very, very good job about like de-leverage the complex of the products. It can be a very, very good translation layer between infrastructure, like what we build is very complicated, to the user, delivered to the user. The user are able to ask a large language model any questions at their knowledge level. The large language model are able to respond to them in the same level of knowledge using the model or data that has been built in a very complicated way by traders. So traders generally known as not good at a communication skill, not able to deliver the ideas, where the agent can do that job for traders. So that actually will reduce the bar of being a good risk manager as well. You no longer need to calculate your theta yourself, look at all this yourself. The agent will be able to tell you, hey, boss, if you don't do anything, you will lose 50K today. That's actually your theta. But he will tell you in a way that you can understand, or everyone can understand. So it's easier. It will definitely lower the barrier to be able to trade option. Yeah.
All right, John, you have your thoughts on this?
I have nothing to add to the AI
that's
story.
all right. Yeah, there's a lot of influencers saying I sleep and the AI is making money for me on crypto, and there are a bunch of AI social trading plugins as well on a lot of crypto exchanges. As we head towards the final part of our conversation, I want to bring in this conversation around risk, right? It is fundamental for everybody, doesn't matter institutional or otherwise, but how risk management is done is very critical in increasing institutional participation. Now, there are 2 points I want to raise, right? One being just how are we seeing risk standards in venues and other places as compared to traditional finance. We've had a couple of instances over the last couple of months where there was, large liquidity events triggered by different reasons. But we've had that, and that's kind of had a blemish on the broader story, but it can also be seen as resilience. But that's one part. The second piece is not just TradFi trading, but generally even the buy side, everyone's kind of programmed for 22/5. If you take, say, futures traders and options traders, nothing beyond that. Crypto is 24/7, right? How do you staff for that? How do you manage when there's a liquidity event happening in the US and it's 3 a.m. here, even if you have your alarm on, you may not be able to react quick enough, right? Somebody may be out partying in LKF during FinTech week and not available to act on it. So how does this balance, how's it happening, and what can be done to make this more streamlined? I mean, you want to start with that, John?
Yeah, sure. I mean, some of it's automation and using really good tools as automatic monitoring. And when something happens, kind of the red lights start flashing. We have a global team that trades 24/7. We have a human being standing in front, or several human beings in most cases, in front of a trading screen, ready to go, all the time. And when an event happens, like it did a few weeks ago in second week of October, no matter what you're doing, you answer the bat phone, and it's time to go and look at risk, and do margin calls and answer margin calls, and so you just kind of manage it. We've been around a long time. We've been through every version of market cycle that we've had in the last 7 or 8 years, and so we have muscle memory a little bit on how to do this thing. Every time we go through one of these events, we learn something new. I think a lot of us were surprised that Athena was hard-coded in a lot of the exchanges to one, which doesn't sound like an optimal implementation, but it ended up being the preferred one in that scenario. Now, so that was, wow, we didn't think about that risk. Like, what are the, what's happening there on different venues? We didn't know that Athena themselves had different treatment that weren't getting auto-liquidated. That was illuminating, because we've been asking for non-auto liquidation for years, and we've been told no, it's not possible. And here there's now a two-tiered approach for some, so that's interesting. So look, it's for us, it's constant vigilance. It's really good people, at least in 3 or 4 different locations around the planet to cover the full spectrum of the globe, and it's having lived through these events to know that these tail risks are always out there. Yep. And we don't know what we don't know, and we have to be prepared for that. Fair.
I mean, I think the truth is there's no easy way around there's no easy way around it, right? We are fully systematic trading, so normally, if market is not super volatile, it doesn't really require high-touch trading from our side. So in general, we are okay. But that's also why we decided to also set up an office in London a few years back, just to be humane, I guess.
Sure. The human in the loop, right? Yeah.
But yeah, but sometimes you just can't control, right? Like John said, over 10/11, when that crash happened, it was like 5:15 a.m. Hong Kong. It was also pretty late London, right? So what we can do is, put enough focus into our infrastructure, software, and all that, so that, when crisis like this happens, you make sure every trader's up. That's all you can do, but it's necessary. And the only thing we can do is stay vigilant.
Perfect. Chris, final words?
I think John and Hans already summarized most of the points, but then I think the question is set for me because we actually just produce all the nice tools to do all the automation, the infrastructure that support 24/7. So that's from day one what we believe will happen in the industry, and that's why we kind of all into the automation. We do automation for structured product, market making, and execution of everything. So that's our actually main business.
The last thing I'll say is 24/7 is coming for every asset
Yes.
under the sun.
We're not ready for that.
It's a
Completely
function of
agree.
time, and it's a when, not an if.
I agree. And look, we're seeing the regulators moving more towards market surveillance, more requirements for in the crypto world as well to be up to institutional grade. Gentlemen, been a fascinating conversation. Thank you so much for your wonderful insights. I hope the audience has gained a lot. The speakers are going to be available for networking outside or afterwards as well, so feel free to reach out to them. And thank you once again to Terminal 3 and Web3 Harbour for having us. Thank you.
Thanks.
Thank you.
Thank you very much, speakers. If you don't mind standing and taking a group speaker photo.